Hello, everybody. Welcome to the technical analysis webinar. We'll be getting started here at this time. My name's Troy. I'll be leading the session. Before we get going, let's do a quick systems check. Just give me an OK in the chat box if you're hearing me clearly and seeing the screen all right. All right, great. I've got enough responses. Thank you. If anyone has any issues as we go along, just let me know. Obviously, a lot of fundamental news driving the markets this week and really for the past weeks, and I'm sure for the weeks moving forward with what we all recognize as a global pandemic at this point, really affecting the ability for the businesses and corporations around the world to conduct business as usual. And so obviously having an effect on the markets, which in a bigger sense is not a great thing, but in a selfish sense, maybe in terms of trading, creates a lot of opportunity for large movements and potential nice profits if you manage the risk accordingly on the downside, which certainly you should try to do. You really could take advantage of some of these movements. And we'll take a look at the technical analysis on the charts today on some of the live movements and take a look at some strategies and concepts that could work well for you. To keep in mind as we go forward, obviously, as we cover each time, all investments have risk. No one move is guaranteed to profit. And this holds true for Forex trading, CFDs, spread betting, options trading. You obviously have some level of risk that's involved. Also, quite obviously, there's the potential for profit, as we were talking about. And the idea is to manage the risk in a way that makes sense for you while going after profits that are worth your while. So you can read the full risk disclosure statement on our website if you wish. Now, keep in mind what we cover is not meant to be financial advisement, but is coming from an educational perspective. Now, technical analysis, there are a couple different ways to go about technical analysis. We lean on manual methods of technical analysis in the webinars. You can make use of indicators, which assist you with knowing maybe when an asset is considered overbought or oversold. Usually, in a market that's ranging, meaning up and down, up and down, up and down, indicators work very well. And so they are useful, but when markets are running in one direction and not ranging, when there's large breakthroughs that keep running in one direction unpredictably, indicators can actually throw you a lot of false signals because indicators aren't necessarily programmed to recognize extraordinary fundamental news that's occurring. And so it can, in one direction, be very accurate, and in the opposite direction, be very wrong. And so indicators, I always say you should add on after you've developed your skills and abilities to read the charts manually, to see the price levels and the movements and the support lines and resistance lines. Once you're able to see all of that and combine your understanding of the fundamental news with it, then you can use the indicator to let you know maybe more precisely when in the preferred direction to make moves. But certainly the manual methods are maybe a preferred way of doing things if you want to understand things yourself and not rely on some other source for when to get in and out of trades. Okay, let's go ahead and take a look first at the fundamental news. And if anyone has questions or if you want to give any input as we go along, please feel free at any time to do so. One thing to keep in mind, especially in times like this, where there's a lot of volatility, if you're trading on gold, silver, any of the FX pairings, you'll find under our trading platforms tab, the AvaTrade Go app. You can download that onto your mobile devices. And on that app, there's a feature called AvaProtect, which allows you to protect your trades against losses for defined time periods, whether it's 6 hours or 1 day or 3 days for a flat premium cost. If the market flies the wrong way, you're covered. Any losses during that time period, and if it goes the right way, then your only cost was that premium cost in the beginning. For times like this, I think it's perfect. It's a perfect feature to be using. So it's called AvaProtect, and it's found on the AvaGo app, which is under the trading platforms, AvaTrade Go. And to see about the feature of AvaProtect, which is on the AvaGo app, you can look under Trading Info, click on AvaProtect, and you see what the app looks like. And you can download the app, again, in Google Play or the Apple App Store, depending on the operating system of your mobile device. And you see, you can choose AvaProtect, 1-day coverage. It gives you a flat premium cost. And again, any losses during that time period are added back to your account. Okay, very nice feature, especially with the type of volatility we have going on now. So let's take a look fundamentally what's happening before we do our technical analysis. Quick snapshot, you can see right away, positive momentum today, okay? The futures market is all green. Stocks finished up yesterday. We look here, these three right here are yesterday's, not the futures. They finished green, and then right into today's futures, green again, okay? And we see the VIX, which is the volatility index, is down, okay? So it looks like fear dipped down a bit today. Some of you are asking, is technical analysis useful during times like this? It certainly is, and we'll take a look at how and why. And yeah, we're going to look at different scenarios, Alex, for sure. Okay, Alex, you're talking about the potential for gapping through the weekend, and certainly we need to talk about that because that's something with the volatility and potential for breaking news stories that's occurring right now. You must understand the risk you're taking by holding trades through the weekend. It's really a high risk that you're taking by holding trades through the weekend. I'll show you what I mean. Very good question, very good point, and it's something I plan to touch on anyways. Now, if you have the AvaProtect, that helps you out, right? If the market gaps the wrong way when it opens Monday, for trades you have open through the weekend, you're covered for as long as your coverage period using AvaProtect runs through the open Monday and into Monday, then if it gaps the wrong way, you're good. If it goes the right way, wow, nice profits, right? So, but we'll talk about how that works out and the risks with holding trades over the weekend. Now, just some quick headlines. Why are things green today, right? There's still a global pandemic, so why did things turn green? If you haven't noticed, we looked at it last week and we talked about that eventually this could create some positive momentum, and sure enough, it did. The US is adding stimulus. Other major countries around the world, China already did. European nations are doing it. Canada, etc., lowering interest rates, buying bonds to help the banks out. Government stimulus has come and is coming. Okay, and so the markets responded to that. Investors put faith in stimulus. You see it right there in the headline. So it may only be temporary, this momentum, right? But it created some momentum today, which was the whole point. That's what countries are trying to do. Dave, it's okay that you started late. We're just getting going. Doing a brief fundamental look before we do the technical analysis. So it was expected that this would create some positive momentum. Okay, and it has with the different stimuluses around the world. Here's another article on Reuters. Markets gain as central banks, governments pour in cash. Okay, it's artificial, right? It's artificial. It's a sign of weakness, actually, that this sort of stimulus is being needed, that governments are having to flood money into the banks. And the US is talking about sending a check of like $1,500 to every taxpayer in the US, like $1 trillion stimulus. The last thing the US needed on their national debt, but in the short term, it's going to help people who are getting laid off because bars and restaurants and all kinds of service workers don't have a place to go to work right now for weeks maybe. And so these checks that are coming out in the US are meant to help people in the short term. And bond buying programs, lowering of interest rates all around the world, nations are doing this. So we're getting some positive momentum today. But then you still have these negative headlines that are there. You see California issues stay-home order, US death toll breaking 200. And you're going to see more and more larger numbers in nations showing much larger numbers of people that have been infected with the coronavirus, not because the spreading necessarily is going faster, but the testing is going faster. So they're starting to be able to see just how many people were infected. And so I think what nations are going to realize is that a lot of people are infected and are getting over it even already. And so this might take some of the fear out of the markets eventually. I think maybe it might create more fear as the numbers go up of people that are infected, as they're counting them, testing them and counting them. But then as people are recovering, and this may have the opposite effect. It may actually alleviate some fear. So it's tens of thousands, even hundreds of thousands that are being counted now in the numbers of those who have recovered from this already. Okay, so there's risk, there's fear, there's mixed headlines, you know, stay-at-home orders for an entire state like California, tens of millions of people. That's not good for the markets. Here, there's a spat between Saudi Arabia and OPEC nations and Russia. Russia says it won't submit to what's seen as oil price blackmail. Okay, the OPEC nations are purposely up production to try and price out Russia because Russia refused to cut production. OPEC was willing to cut production to help oil prices stay up, and Russia said no, and now they're having kind of a production war to try and drive the price down to hurt each other. Okay, really bad timing when there's also a global pandemic, right? But for the average person, I guess that's good news. You fill your tank up cheaper. I'm sure gas prices are on their way down with all of this. But with the temporary optimism, we saw oil jump up above 30 today with all of this green that we're seeing in the market with the stimulus momentum. But then we saw oil drop right back down to 25. Why? Because these are the overall driving headlines. Russia won't give in, at least for now. Major states and nations giving stay-home orders, businesses, factories. I even saw Tesla, their production factory is basically shut down as of the last headline I saw. So major companies, major stocks being affected, which means major indices also being affected. So right now, the momentum, and we saw it with oil, was short-lived. And that's kind of how I pointed this out. Probably short-lived momentum, okay? Excitement about stimulus, but still worries about price wars with oil, major economies being shut down. And that's basically the situation right now. So if then we go to the charts, let's take a look at my demo account at the live movements and get an idea for what's happening. Now, I know the NASDAQ hit the up limit today. For those of you that don't understand these down limits and up limits, there's certain triggers that were put into the financial markets to allow people time to cool off, to think if the markets move, say, 7% in a one-day time period. There's maybe a 15-minute delay, then it goes back on. Another 7%, another delay. If it drops 20%, trading ceases on that asset for these indices for maybe the whole day. Okay, now we're trading on futures, so these delays are just waiting on price movement and they can start back up. But also, when the U.S. market comes open here in just a little bit, we may see that the NASDAQ gets going again if it hasn't already. Let's take a look. Let's go to 30-minute candles. And we see some movement. Okay, so we do have movement on the NASDAQ again. We see it pulled down. Okay, so short-lived momentum. And let's take a look then at the technicals on this. We see a little bit of a support level here that was broken through. All right, this was resistance and it broke through on the NASDAQ on the way up. And now we see it's broken back below it on the way down. So a lot of momentum, a lot of strong movements. And if we're looking that this is a broken support, it becomes resistance again. We're looking at potential drop to the next support level down here, okay, which is quite a ways down. And we're looking at resistance level up here, all right? Now it already broke back above this support. You see this here. So technical analysis would say momentum broke back above the resistance, which is now support. You take a shot at a buy, could do a market move, and you take your profit before the next resistance level. Okay. How do you manage your risk? Where might you put your stop loss on this move? I'll take a vote if see if someone's thinking the same way as me. And obviously, I'm not showing you the trade you should take. You do this if you think it makes sense. But if you were buying on this, if you were taking a market move now, thinking that this might go back up to that resistance level, where might you put your stop loss right now? In relation to this broken resistance back above, where if you were doing a buy move, where might you put your stop loss? Yeah, some of you are saying back below the support level, the broken resistance, which then would put you back down here. Okay, so limited risk, much larger potential rise. Okay, you could take shots like this. Yeah, you're saying about 7,400. That makes sense, Dave. I drew a line. It happens to be 7,420, but you might go just a little lower than that to be more patient with it. Okay, just below this low point. So you can take a shot like this 3 or 4 times, right? And the way the markets are moving, man, it doesn't take long to go flying up to that next resistance level, right? So if it runs up, great. If it came down to your stop loss, okay, fine, then you try again, right? And if it comes down to your stop loss, what kind of pending order can you have ready right here to sell? What kind of pending order? If you did a market buy now with your stop loss down here, what kind of pending order would sell from down here? Say right about here. No, sell limit would be selling from a higher point. Sell limit you'd program from up here, which I agree isn't a bad idea as well. Yeah, Marius, sell stop. Okay, so if you did a market buy, you're taking one shot. If it breaks the support and comes back down, you got your sell stop ready to go right here. Sell stop, right? And if it does break and triggers your sell stop, stop loss is back up here on the sell stop, back above the support. Okay, and in that case, you could have another trade programmed up here as a buy stop, right? Bouncing above below that major support level until it makes a run. Look at the chart. How many times does it have a false move before it makes a big run? Not very often, right? Looking at the history here, there are big runs all over the chart. So let me walk you through the sequence. Let's say I did a market buy. And I'm not saying you should, right? But if you did, and let's say it was wrong, it comes down, hits your stop loss, boom, triggers your sell stop. Let's say that was wrong, comes up back above, hits your stop loss, triggers your buy stop, and that one makes a run up. My win percentage is no good, right? 33%, 1 out of 3 I win on that scenario if that happened. But my P&L is great, right? Because I only lost a small distance here to my stop loss. Triggered my sell stop. If it goes back up, boom, hit my stop loss. Okay, lost twice. Triggers my buy stop up here. It goes running up and I win. I only needed to win 1 out of 3 and I'm in overall profit because this distance in profit is double this and this added together for the 2 potential losses that we're saying might have happened there, right? So when the markets are running so far, so fast, once they get going, right? Then you only need to be right once, maybe even out of 3 or 4 tries, and overall you're still winning. So this is the idea. In a volatile market, there will be big movements. You just got to catch one. And when you're wrong, you got to limit your losses in the wrong direction and get in. Don't be afraid to get in the opposite direction because that might be the direction that the big run is coming. So in this scenario right now, we'd be saying, oh, my market buy, it's losing. It's coming down. Maybe it's about to trigger our sell stop and get out of the buy, okay? Eventually, we're going to get a big run one direction or the other that's going to be correct, okay? You just got to limit the losses on the entry points and be consistent with the strategy, and eventually you can catch a big run. Okay, and that didn't quite hit the stop loss yet, at least the line that I drew. So we'd still be waiting on it on the first move to wait and see, is it going to trigger the sell stop yet? Okay, so in this scenario, we're still waiting to see if that first move would be correct or not. But again, limiting the risk each time. Let's take a look at crude oil. So here we see the general momentum coming up, and this one was easy. Okay, look here. You see this wick? You see this spike up? Exactly here. Look where this reversed. Look where it reversed from. So when we got the positive momentum today, and this was coming up, look at what kind of order would you have put right here? As this came up to this spike, to this resistance level, what kind of pending order, as this was climbing, what kind of pending order would have sold from right up here around 28.2? Yeah, no, not buy limit. If it was climbing and you saw the spike height here, what kind of pending order sells from a higher point? Not buy limit. Sell stop buys from a higher point. Sell limit. That's it. Good. We got it on the third try. If we were playing baseball, we're still good. You're not out till you have 3 strikes. Okay, so that's it. A sell limit, as this was climbing, you could have done your technical analysis, looking over here saying, okay, there's the spot. You could have programmed, as this was climbing, a sell limit to sell from this price, I don't know, around 28, and look like clockwork. It got to the same height, and down it went. Okay, already dropped $3 from just 1, 2, 3, 4 hours ago. Okay, you say, okay, $3, is that much? Depends on your trade size, right? And your balance, what that means to you. $3 drop can be a huge profit. A 1-lot position, you're making $1,000 per dollar, that you're in the right direction. This is just simple technical analysis. You look at the spike. You know, a lot of traders who trade technically are waiting for this mark. It hit and down it went. Very simple move. And the idea that when we saw that everything was green today and that oil was climbing and the futures were climbing, you understand that that's probably temporary momentum today. And it was temporary. So response to some of these stimulus measures that, okay, that's good, that might help out, positive momentum, but then you understand, okay, once it reaches a resistance level, there's still a global pandemic. So why don't we take a shot with our technical entry points? And how much would you have had to risk on this move getting in at this resistance point? You put your stop loss right up here. If it breaks the resistance, you're out. So you didn't have to risk much, and look at the potential gain that occurred. All right. Now, as these movements start to hit support levels, you might say, hey, there's still some positive momentum maybe today. So you start to look and you say, all right, what if oil reaches this support? Okay, resistance, resistance. Here's the breakthrough here, breakthrough candle on the resistance, and up it went. So if you were going to do a buy limit, buying from a lower point, pending order, what price might you think? What price might be opportunistic to try and take a shot at buying a buy limit pending order? You see the old resistance, right? Resistance, resistance, breakthrough. So now it went up, found the resistance and back down. Yeah, maybe 24.5. Some of you are saying, right about where I drew that line, right? Just above the old resistance, which should be support now. Okay, so 24.5, 24.6, 24.7, something like that makes sense. And maybe you don't bank on it going all the way back up to 28, but maybe you say, I'm going to do a scalp. If it bounces off this price for maybe $1, boom, I take my profit, right? Because there likely could be a bounce off that support level. Now, overall, there's still doom and gloom for oil, especially because of that headline we looked at. Russia and OPEC still trying to battle each other on oil price. That's not good news for oil. So in general, even if you're trying to get a bounce off of this support, and even if it's right, Okay, let's say you gain a little bounce, a dollar, bounce back up, you take a scalp. What probably should you prepare below this support level? Because the news really is right now not so good for oil. If it breaks this support, you can back yourself up with what? Kind of pending order. If it breaks that support, gets you in. A sell stop, exactly, Marius. And listen, even if it doesn't give you the bounce and it breaks the support and you lose that small distance to your stop loss down here below the support, and then it triggers your sell stop and goes down to the next support level, you're in overall profit still, right? The next support level's $2 or $3 down. You risk maybe $1 to your stop loss on the buy here, 50 cents even. So again, same as we were looking at with the last asset, you don't have to be right on every one of these moves. You get in with an opportunity for a large movement. You risk a certain amount that maybe is much less than the potential profit. And in that manner, in a market like is happening today, look at the runs that are occurring. Look at the run this made. Not one green candle. Once it hit the resistance, red, 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 red. Momentum. Huge movements with the volatility that we have now. So if you're wrong, okay, maybe you want to get out quick with your stop loss. If you're right, look at the potential. You only need to be right maybe 1 out of 3 or 4 times and you can still profit. Okay? Where the bigger risk comes in is if you say, okay, I'm going to keep moving my stop loss. If it breaks the support and you say, no, 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 let me move my stop loss down here. And it breaks that support and you say, no, let me move my stop loss down here. If you just keep thinking that you have to be right on the first move with a market like you see now, it could just keep running the wrong way over and over. To just keep risking more on the same move, even when the technicals tell you you're wrong, if you're buying off this bounce and it breaks, in a market like today, you really could get blown away if you keep moving your stop loss and thinking, oh, well, it has to bounce off the next one and I'll double up and buy again. And it breaks that support and you double up again in this. If you keep going in that same direction, you could be wrong 100 times because the markets are running sometimes the way they are now, like this right here. It broke one support. It broke the next support. It broke the next support. Imagine if you kept trying to buy when it kept dropping. It could happen again. So that's the idea of what we're talking about now is when the markets have the potential to keep running in one direction, you can trade on the reversals, but also don't be afraid to have a short stop and get in the other way. Okay, because you can get in on these long runs if you're willing to accept that you're wrong if it doesn't go the way you thought the first time. Beatrice, thank you very much. I'm glad it's clear for you. If you haven't recognized, back in the States, I used to be a teacher, teaching math and science. So numbers, logic, statistics, they all make sense to me. And really, looking at these charts, you could start to see them like repetitive music notes. You start to see where the tempo changes. Okay, where it's repetitive, and then a break in tempo. And when you see that break in tempo, that's the breakthrough of the support or the resistance levels. And then you go with the new tempo. And so if you're willing to do that in a market like is happening now, you really can take advantage of some of these large breakthrough movements and only lose a little if you were wrong. Okay. All right. So this is a good example of one. Had we had the webinar, I don't know, 4 or 5 hours ago, you could have gotten in on this reversal because that was the resistance mark. Now here's our support. You start to see double wick. You see this wick, wick. As you start to see double and triple wicks at the bottom, that's sign that it's starting to respect this support level. And even if you get a small bounce, great, you can get out. I'm the type, I don't like to hold positions for long movements if the fundamentals are working against me. And right now, the fundamentals are working against a rising oil market. So if my technicals say buy, but my fundamentals say sell, then I'm not looking for this bounce necessarily to go all the way back up to the resistance. I'm looking maybe for a temporary bounce and then I'm out, a small bounce. if it breaks through the support, I feel it has more potential to go all the way down to the next support. So I'll be more patient with it. Why? Because the fundamental news is in my favor in that direction. Okay, so you can trade with and against the fundamental news if you have proper technical entry points, but you might be more patient in the direction that goes with the fundamental news and less patient, quicker in and out when you're going against the fundamental news. Okay, let's take a look then at the indices. Let's look maybe the FTSE. Okay, here we see the temporary momentum. Why was this reversal, this spot here, when the FTSE was climbing today with the positive momentum we looked at in the fundamental news when we first started? Why was it predictable? This is the spot you would take your profit and have a sell limit prepared to sell. Why was it obvious that that was the spot for your sell limit to kick in, and that was the spot where you'd take profit on the way up? Why was this an obvious price level right here around 57.70 or so? Why was that obvious that that's where you'd get out? Yeah, resistance. Look over here. Look here. Let me draw the line. Isn't that almost perfect? Look at the resistance level. This is technical analysis, everybody. And in a market like today, it works very, very, very well because a lot of people are trading technicals because the news is conflicting. You know, normally when interest rates are lowered and stimulus is given, the markets just keep climbing. But we've got this conflicting parameter or conflicting news items to trade on, meaning more stimulus to businesses, lower interest rates. Oh, good news. Oh, wait, there's a global pandemic. Bad news. So these support and resistance levels, when there's a breakthrough, the next one is likely not to break and you'd have a strong reversal. If a support level gets broken, the next one maybe is going to have a nice bounce because we've got conflicting news back and forth. And you can be wrong on one and right on the next one. It's okay. So here's the resistance level. It came up, it tested it a little bit and right back down. So if you were buying on the good news, if you'd have looked back this morning, you'd have said, okay, it broke this resistance level here, right? Here was the technical resistance level. Once it broke through, you could have been up on the rise, and then you'd have known where to get out right here, just before the resistance, and you'd have been out, okay? Once it started to bounce back down, now you're in on the sell. Where would you take your profit if you're scalping? The next support level, which is here. Resistance, resistance, breakthrough, okay? So the entry point on your buy here is the exit point on your sell here, if you're scalping, right? If you're more patient, you'd say, no, wait for it to drop further, right? Now this already broke this support down here. So you might be looking to say, okay, let me be patient. If it breaks back below this low point, okay? If it breaks below this low point, then the downtrend is continuing. So you might say, sell stop program below that low point. Sell stop program down here. And you might also say if it breaks past this high point here, then now I put a buy stop. I could put a buy stop right up here to go up. Okay, so buy stop buys from a higher point if it breaks back above this resistance. Then you're in with a scalp up to the high point today. If it comes down and breaks this low point, you're in with a sell stop. And you could either be in and out quick, here's the first support, or more patient, you've got a support level way down here, okay? There's obviously both options that you could do. Right now I'm looking at 30 minutes because it gives me a good view for scalping. For short-term moves, you're probably looking at maybe a 30-minute, 15-minute candle, even 5 minutes. If you're in it for a longer-term move, then you should be looking at larger candles for the bigger picture. Today, I'm focusing on short-term moves because they're paying so well. You've got huge movements on these indices, on gold, on oil, in short periods of time, and your entry points need to be precise. Okay? If you're looking at holding positions for the next 6 months, heck, I could be on Dow Jones, put in $20,000 in my account, put my stop loss down below, I don't know, 18,000 and just be patient on a buy position and wait. Eventually the indices probably will come back up, right? Now 18,000 might not be low enough. Maybe I take a smaller trade and I put my stop loss down below 15,000 on the Dow Jones and just wait. Then I don't have to be so precise. I don't need to look at 15-minute candles or 30-minute candles. I'm probably looking at 1 week and 1 month candles. So it all depends on your perspective. Are you scalping or are you a long-term move type trader? Right now, huge potential in short-term moves. This is almost signaling a buy, right? If it breaks our resistance and hits our entry on our buy stop, we're in on a buy. If it breaks our support on a sell stop, we're in on a sell. Eventually, you're going to catch one of these big movements. And if you're limiting on the downside, your stop loss just back to the other side of the resistance or the support, you're not risking much. Maybe you're taking a trade size, so you're risking maybe 1% of your balance to the stop loss each time, but you might make 4% or 5% if it goes the right way. Okay? It's not the only way to do things, by the way. You can have your stop loss further away than your take profit. It's another way of trading. You'll be right more times than you're wrong usually when you do that. But then you need to win more times than you lose to profit, which some people do that as well. I think in today's market, the opposite maybe makes more sense. Closer stop loss, quick out if it's going the wrong way, because boy, can it run the wrong way if it goes the wrong way. And a little longer distance to your take profit, because when it's going the right way, it really can go quick and give you some big profits. Okay, so that's the FTSE. We could do the same thing on the NASDAQ. It looks exactly the same, doesn't it? We've got support down here now. Could do a sell stop if it breaks. It's breaking above the resistance. You could do a buy stop if it breaks through, or a market buy maybe at this point. Gold, let's take a look. You almost don't even need to look at the news, right? Just technical trading can win in times like this. Right now, it's on the support. If it breaks that support level, you see the old resistance, breakthrough, this should be support. If it breaks through, you could do a sell on gold with a sell stop. Okay? This is in such a strong downtrend. You have to be careful necessarily buying up off this support. Let's go to 5-minute candles. Okay? You see wick bounced up. Wick bounced up. It's trying to break this support right now. If it breaks the support, you could be in with a potential sell. Okay? It has not broken the support yet. Okay? You could do a market buy off the support. It looks like it's trying to bounce. Market buy backed up by a pending sell stop. Okay? Both could pay well, and you only need to be right on one. And we see gold just bounced off that support, $3 already. If you're scalping, you're up. If you're market buying, you're up. Okay, where would your take profit be on this? If you were bought on this when we were saying you could do a market buy, where might your scalping take profit be? Maybe at the first resistance level right there. Okay, you see support here, support, breakthrough becomes resistance. Okay, so a scalp up might be around 1496. A pending order waiting in case it breaks. Okay, so gold's really moving as well. It looks actually tremendous, the amount of movement that it's giving you. And I think it may break that support sometime soon. Again, if I was scalping on this, the bounce up, I probably would have taken the profit already. I'd be more patient with the movement down, because a lot of people have been selling their gold to get access to cash. Usually when there's fear, gold goes up. Lately, because it's such a dire situation with a global pandemic, many have been cash taking from their gold to have cash on hand. Okay, so that's why gold has maybe been doing the opposite of what people expect when there's fear, because the fear is so great that this is the time that many people are cashing in their gold. So this support could easily break while we watch it, but let's take a look at the Dow Jones. Look here. That's an opportunity, folks. There's the old resistance. This is where today's run up started, right here. Okay, 5-minute candles. You see the breakthrough and the run up. Okay, resistance, breakthrough, run up. Here's our resistance at the top. So if this reverses and breaks back into an uptrend, if it breaks back into an uptrend, you've got an opportunity here. Let's go to 1-minute candles. You see it just broke the support. If this movement was to break back above this mark here, okay, you see this is the breakthrough level right now. This was support, support, breakthrough, right? If this comes back above this broken support, then maybe it's going to try and come back up some. Okay, this is the advantage. You were asking what candles should you use. This is the advantage of using an outside-in look. We were looking at 15-minute, now we're on 1 minute to see more precisely what happened. Here's the broken support, and then you see the run. So let's go back to 15-minute. Okay, so market move would be sell. It broke the support, right? It broke the support. Pending move would be if it goes back above the broken support, a buy stop waiting to go. Okay, and so both of those are possibilities. FTSE looks a little different. And the FTSE, oh, that's a 15-minute candle. Okay, yeah, it's moving. You see this one bounced off the support and is coming up. A lot of times the indices move in the same direction, right? So you see this is bouncing up off the support. Likely we may see the Dow Jones then bounce back up, okay? I really think the move here is a pending buy stop. If this comes back above this was the resistance support. It tested dropping, right? But it's got another support down here. You see there's a second support. If this comes back above here, above this broken support, without breaking this one, you could see a little bit of a run back up. So a pending buy stop up here seems to make sense. A pending sell stop below this next support makes sense. This is kind of the neutral zone. Back up here, buy stop. Down here, sell stop. Limited risk on both. You could catch a big run. Okay, this is pure technical trading. Indecision zone in the middle, buy stop if it breaks above this broken support, sell stop if it breaks the next support level. S&P 500 doing the exact same thing. I think we could see a bounce back up eventually here. That could be quite advantageous. Some are asking for the pound. Let's pair the pound against the yen. I think this will be the last asset that we look at. GBP, JPY. Where is it? Maybe I have it at the top. GBP, USD. Let me find it. Here it is. Okay. GBP. Ooh, look at that. Look at that opportunistic entry point. Okay. Resistance level. If we go 1 minute candles, okay, you could easily take a sell here, right? It's starting to downtrend. We see the double top. You could do market sell, stop loss. Let's go back to 15-minute candles. Stop loss up here, okay? Huge potential if this corrects back down, right? Huge potential if this corrects back down. Why might we expect the yen to strengthen right now? Mubarak, why might we expect the yen to strengthen? Didn't we just see that the indices were pulling back down? That means fear might be coming back. What is the yen considered? A safe haven, exactly. We just got maybe some support for the idea that fear is coming back because we just saw the indices were breaking 1 minute candle support levels. Okay, if the indices are breaking support levels, that means fear. That means maybe the yen will strengthen right now. So a market sell right now in GBP, JPY makes sense, technically speaking, from the other assets we looked at and this asset, because we're at a reversal level. We're at a resistance level, I should say. which it's turned into a reversal. And you only have to risk a little bit to the top up here. And if you're saying, where should I take my profit? A quick scalp would be here. A more patient move would be the next level down. Okay, here's the next support level, this old resistance breakthrough. Here's the first support level. So first profit here, second take profit mark would be here if you're scalping. You could do a partial close, by the way. I can go GBP, JPY. Let me show you how to do that. Let's say I do one lot. Okay, sell. Okay, so let's say I'm in on a sell, and let's pretend that it dropped down to my support level here, and I say, wow, it dropped with so much momentum. Maybe I'm thinking it'll keep dropping, and I want to keep some of it open, but I want to preserve some of my profit. So how do I go about doing that? I can do a partial close. So let's say it's in profit now. It's not, but let's pretend it is. And I say, okay, I want to close half of it. So instead of doing modify, I switch and go to market execution. Okay. And then when I'm on market execution, let's say I wanted to close half of it because I think it might go to the next level. Let's say the movement is here right now, and I think it might drop, but I don't want to lose all my profit if it comes back up. So then I can change the volume to, let's say, 0.5. So this is the amount that it will close, whatever I put here, and it'll leave open the rest. So let's say I like my profit level and I want to close. So I come down here, I change the amount I want to close here, and then I come down and I'll see it says close, order number listed 0.5. If I change this and I say, no, I want to close only 0.4. Okay. Now you see down here, it says close, order number 0.4. So I can leave the rest of the trade open and close part of it. This is a nice strategy for preserving profit, but allowing the potential for it to keep running in times like this if you think it has the potential to break the next support level and keep going. Okay, so partial closes. So I would close part of it. Now you see 0.6 is left open. Okay, I know the pound was experiencing a lot of negativity not that long ago. And so you might view this as an opportunity with a small risk, if it breaks above the resistance, to go after a large potential profit. Shika, yes, it is recorded. By Monday, it'll be uploaded on our YouTube channel, and you can watch the whole thing again, even though the timing of the moves won't necessarily make sense because we're looking at short-term moves. The strategy you can still watch, and it still will make sense for movements that you could look at next week. Okay, just go to YouTube. Okay, just go to YouTube and type in the search at the top, AvaTrade channel, and you'll find it. And then there's a page for English webinars. You'll see both my webinars listed, and Naim is also doing English-based webinars as well. Okay, he's doing the ones that are titled Masterclass, something like that. Okay, those are nice to look at as well. All right, so any questions about why it might make sense to sell on the pound now? It's basically a combination of fundamentals. We think the yen might have a reason to strengthen, and technical entry point. It's at a nice resistance level where you don't have to risk much to the other side for your stop loss. Mubarak, I started to allude to that before. Here's what happened with gold. A lot of times people are watching the bond market, the yield on bonds versus the price on bonds. And so there's a trigger that many people are looking for, that when the yields on bonds get too low, and you understand that when people have fear, they buy gold, they also buy bonds. Bonds are guaranteed return, a guaranteed yield. When there's so much fear that so many people are buying bonds, the banks raise the price on bonds. Okay, higher demand, they raise the price and they lower the yield. They lower the payout for the bond. Okay, and so when the prices got so high and the yields got so low that nobody even wanted to buy bonds, okay, the only place to get assured payout was people started selling their gold. Okay, so it gets to where if there's fear in the markets, yeah, people buy gold. But when the fear is so high that the bond yields drop so low that it's viewed as potential catastrophe time, people want their cash. They want, because you can't take a gold bar and go pay your mortgage or keep your business afloat with a gold bar. You need the cash. And so people buy gold for times just like this, meaning you're buying gold as a safe haven because you think the price will go up when other areas are going bad. And it did. Remember, gold not that long ago was at 1,200, 1,300, 1,400, 1,500, 1,600 an ounce, 1,700 an ounce, right? So people were right. They were buying gold for when there was a really bad time. And guess what? The really bad time hit. And now they're cashing in. The whole reason why they bought gold was so that they had something of value in case they needed cash later. And now they need the cash. So the fear got so high and things got so bad that gold was being cashed out. And yeah, the markets were dropping and gold was dropping and everyone's thinking, what the heck is going on? If you read the articles and you watched some of the webinars I did a few weeks back, we talked about the bonds. We talked about the yields being a warning sign that people could start cashing out gold. And that's what happened. So watch the yields again on bonds. If the yields go up on bonds and start to be nice again and bond prices drop, then the new safe haven is back to gold, right? People start to have less fear that they have to have the cash now, and they could start buying back into gold some. So good question, and a somewhat complex answer, right? Again, if you're unsure of the direction something will go in terms of fundamentals, then stop using the fundamentals and use what we're looking at now, the technicals, and just wait for the breakthroughs and the bounces. Purely technical traders are having no trouble with the fact that gold was going the opposite that the fundamentals said it should, because they're just waiting for the marks on the chart and trading. And they were making money hand over fist, technical traders, as gold was breaking support levels. Their sell stops were kicking in. They didn't have any mental connection to thinking gold had to go up. No problem, sell it. Broke the support, sell stop, it pays well. Okay. All right, good question, Mubarak. A lot of people have been wondering that. Okay, I think this is a good place to stop, everybody. We've been going for almost an hour. I think you see some huge opportunity here with the pound, huge opportunity with oil, and obviously the indices. I promised I'd talk about gapping and the risk over the weekend. You want to be careful. Let's say you sold on the pound here right now, okay? And let's say it was a sizable position because you said, wow, I can take a big trade because my stop loss doesn't have to be far away. So I can take a big trade and not have to risk much. And boy, I could make a huge profit. And let's say it's going the right way now. And you say, okay, great. I only have a risk to my stop loss. Guess what? If the market closes today on Friday and over the weekend, let's say some really good news comes out for the economy and for the pound, and the yen weakens and the pound is strengthening, what could happen when the market opens on Sunday night / Monday morning? It's a 3-letter word, starts with a G. What could happen? Yeah, a gap. You could have a gap. And if you were selling on this, you carried it through the weekend, and when the market opens Sunday, it gaps way up above the resistance, way past your stop loss. If that happened, you'd lose to the price that the market opened, not just to your stop loss. And it could gap significantly further than your stop loss if news over the weekend is dramatic. And if that news works against your direction of trade, and you never know what news might break over the weekend, if you don't want that risk, you close your trades before the weekend, before the end of day today. Reopen when you know the news from the weekend, reopen again on Monday, okay? You don't have to close before the weekend, but you have to understand that that risk is there of significant gaps, especially on gold, oil, indices. You know, the Dow Jones could gap several thousand over the weekend from where it is Friday to where it opens Sunday night. If you're in the wrong direction, it doesn't matter where your stop loss was. It could gap way past your stop loss. You could lose more than you intended. Okay. So keep that in mind. Be very careful in these volatile times with carrying trades over the weekend because the gaps not only could go in your direction, but could also gap against you. Okay. All right, great. Thank you all for the good questions, for the participation, and good luck with your trading. Just be careful with carrying anything through the weekend. All right, bye for now. Thank you, Dave.